Good evening, everyone. Am I audible? Let me confirm. Yes, friends, I believe I'm audible. Good evening, my dear friends. Hope you're all doing good. Perfect, perfect. Shall we start with session 2 now of Super 30? So, today we will do the remaining 30 questions and we'll wrap up with the entire thing. All right, friends. Even before I start, today I would like to add you to another batch, which is another free batch, which is called as the AFM Success Series. All right. So, all of you have already installed my app. Am I right? I'll just tell you a batch code, send me a request there. In that SFM success series, sorry, AFM success series, what I have done is I have made videos in such a way that you can revise the entire chapter in a very, very short span of 1 hour. So portfolio management, 1 hour. Security valuation, 1 hour. Forex, 1 hour. So like that, in less time, you can complete a lot of topics, friends. All right. So even before that, two batches, it's all free for you, friends. It's just for your benefit. There are 15 students enrolled for the MCQ batch. Yes, here, friends, for example, if you go to the test, see over here, we have test for security evaluation. So I can see how many people scored how many marks. Aditya scored the highest marks, 40 out of 50. When you talk about portfolio management, also I get the whole analytics here. Sebin Joe scored 43. Mutual funds exam is there. So the moment you request the batch and you enter into this, you can write these exams on the spot. You will come to know how much ever marks. So the batch code that you have to request in your app, go to batches, request for Jan 2026, JAN 2026. You will be able to access the weekly MCQs. All right. Same way, if you are searching for one more batch code, I will tell you AFM success. Yes, there are 3 requests already. AFM success. Request this batch code. The advantage of this batch code is, I will just show you. Here, if you go to the videos, see, in this one video, in just 1 hour time, I have revised the entire portfolio management. Here, I have revised the entire mergers in 1 hour. Here, the entire international finance. And here, I am giving you some extra tricky questions also. So, friends, like that, when you cover all these questions, all these will very, very easily help you to learn things in a much faster way. All right. So, this was the today's extra benefit that I am sharing with you as a part of this Super 30 series, friends. Now, shall we begin with today's class? So, yesterday, I believe we reached up to question number 15. Shall I now go to question number 16, friends? What is the page number? 6.44. All right, this is the question, correct? Yeah, 6.45, 6.44. Yeah, this is a very, very good question, friends. Let us do this question together now. All right. Ready, friends? So, question number 12, mutual funds, page number 6.44. Working note number 1, basic data. They have given you a table, particulars, X, Y, Z. Point number A, audio is very clear, right? If any concerns, just let me know, okay? Right. So, amount for 2 lakh, 4 lakh, 2 lakh. All right. Point number B, NAV is given. NAV at the time of purchase 10.3. Then what do you have? 10.1. Then what do you have? 10. So at the time of purchase, if this is the NAV, can I find out the number of units from this, friends? I'll put that in a reading pen. Number of units. Do I get the answer as 19,417.47 units? Here, do I get the answer as 39,603.96? The last one would be 20,000. Am I right? Okay. Once I get the number of units, let me go to the next part, friends. 1 minute. Yeah. Dividend they have given as 6,000, 5,000. From this, can I now find out the dividend per share or dividend per unit? Can I find out? 6,000 divided by 0.309, 0.25. Okay. Once you get this, they have given you the NAV as on 31/3/2018 is also given. NAV closing 31/3/2018, whereas the amount of investment is on what date they have not told. Okay, 10.25. What is the second one? 10. What is the last one? 10.2. Can you quickly write down the basic data till here, friends? All right. Can I go to the next part now? So once you are done with this, they have also given you the yield per annum. So I'll keep that pending. We'll write down in the next page. So basically what is happening? How do you find out the yield per annum? NAV1 minus NAV0 plus D1 divided by NAV0 should give you the yield. Correct. But here the duration they have not given. So I'll just show you. I'll write down the next working note. Analysis of mutual fund X. Friend, X I will do, Y and Z you have to help me doing it. So what's the formula for getting the yield? 9.66% is the yield per annum. So it's for 1 year. That should be equal to 10.25 closing NAV minus 10 plus 3, 10.3 plus the dividend amount. What's the dividend amount? 0.309 whole divided by whole divided by the opening NAV. This will be for some number of months. So into 12 divided by some number of months, or maybe if I put divided by some number of days into 365 will give you the 1 year data, correct? So can you help me solve this and tell me what will be the value of X over here, friends? Can someone please tell me the answer? $95. Do you get the answer as 95? So X will turn out to be how many days over here, friends? X will turn out to be 95 days. All right. Like this, can you now help me to find out the value for mutual fund Y and mutual fund Z on your own now? Come on, friends. Can you do this now? Same way you have to do it for Y. So what will be the equation? Minus 11.66 is equal to 10 minus 10.1 plus 0 divided by 10.1 into 3. Same way. Can you do it like that for same way and tell me what is the number of days you get for Y and what is the number of days you get for Z? Rahul, you get 31 days for the second one. 31 days. What about the last one? I'll show you the answer now. You got 95 correct. Second one is 31 perfect. And the last one is 68 days. Okay, let everyone do it, friends. I'll give you some more time. Perfect, friends. Are you all clear so far? Are you all clear with the concept of 31 days, 68 days, and 95 days, friends? Yes, derivatives is not available. Remaining chapters are available there. All right, friends. Are you all done writing till here in your books now? Perfect. So once you get these days, 95, 31, and 68 days, once you get this, we know the closing date. What is the closing date over here? I think the period is given in the question. That is, the closing date is 31/3/2018, correct? From this, if I minus this number of days, can't I go and find out the opening date now? So I will write down the next working note heading, opening date, particulars, X, Y, Z. We already know the closing date. What is the closing date? 31/3/2018. We know the days for which each of these are outstanding. For example, the initial one is 95 days. From this, can I do a reverse working to find out the opening date? I think it will be 26th December 2017. Please cross check from your side also. Like this, can you fill it up for X, Y, and Z, friends? Perfect. Like this, can you do for the remaining friends? I think they have done it here. They've got 27 December. That one day up or down is okay because you can take it as including or excluding. So that's okay. You can get either 27 or 26. Both are absolutely fine. All right. Perfect. Then the second one is 1st March. Last one is 23rd January. Just do this on your own. All right, friends. Are you all done writing till here in your books now? So we are done with this part. Let us go and check what else they have. They're asking the number of units in each scheme. We got the number NAV. The total NAV they are asking, friends. Hold on. I think we didn't find out the total NAV, right? Did we find out the total NAV? No, right? I think we can find out the total NAV also. So we'll write down the next working note heading. Total closing NAV. Particulars X, Y, Z. So we know the number of units. What's the number of units we got over here? It will be available over here somewhere also. Yeah, 19,417.48. What about the second one? 39,603.96. And what about the last one? Last one will be 20,000. Correct? Fine. Point number B, we know the closing NAV also. What is the closing NAV? 10.25, 10, and what about the last one? 10.2. So from this, can we go and find out what will be our total closing NAV? All right, friends. Can you write down and finish it off? So we are done with this question also. Yes, Balaji, that answer is correct. Everybody clear with this part? So friends, we are done with this particular question. What is this question number? Hold on. I think it was question number 12 or 16. 1 minute. 12, right? Okay. So we are, sorry, it's question number 12 that we did now, correct? Oh, they want us to do 11 also. Okay, we'll do 11 after this. So 12 is done, friends. All right. Now, shall we go and do question number 11? I think I forgot 11. I directly went off to question number 12. Friends, now can you read through question number 11? Are you familiar with these numbers? This question is exactly the same as question number 12. All right. What only they are doing is that instead of doing a reverse working like we did, here they are doing a forward working. So basically, they're taking the date, amount, NAV is given. They want you to find out the effective yield per annum. It's a very, very easy question. Let's not work it out. Let's read and discuss. So, number of units first they found out. Dividend per unit they found out. Number of days they found out, and then they found out the return per annum. So I'll just give you 5 minutes time. Working note 1, basic data, quickly write down this in your books. Then you can write down this. So in 5 minutes, you will comprehend the whole question and then we can go to the next one. Please write down, friends. All right, friends. Are you all done writing till here in your book? So we are done with question number 11 also. Shall we go to the next question now, which is question number 16. Ready? We have 13, 14, 15, and then we have, wait, question number 16. It's a question on NAV. Shall we do it together now? Okay. So question number 16, page number 6.51, additional questions of mutual funds mastery book. Let's do it together now. Basic data. Mutual funds made an issue of 10 lakh units of 10 rupee each on January 1. That will turn out to be how much, friends? It will turn out to be 100 lakhs. Am I right? Now, down they have told from this 100 lakhs, they have put in equity shares of 80 lakhs. Government security, they have put 8 lakhs. 9% debenture unlisted, they have put 5 lakhs. 10% debenture listed, they have put 5 lakh. 98 lakh they have put. Friends, 100 lakh they received. 98 lakh they have put. What does that mean? How much is the balance, closing cash balance available over there? Friends, closing cash balance available will be 2 lakhs. Everybody clear with this part? Okay. So now, based on this, during the year, dividends of 12 lakh were received on equity share. Okay, so I'll just write down that. Dividend of 12 lakh was received on equity share. Interest on all types of debentures of debt securities was received as and when it is due. At the end of the year, equity shares and 10% debentures. So basically, 12 lakhs were received. Interest was received as and when due. So interest was always received. Interest was received. At the end of the year, equity share and 10% debentures are quoted at 175% and 90% of the value. So equity share 175% value. So hold on, 175% are quoted at 175% of the face value. So 160 will become 175. So revised equity value will be how much, friends? It will be 50,000 shares into 175. Do you get the answer as 87 lakh 50,000? Am I right? All right. Next one. Same way, 90% of the face value in case of 10% debenture. So this one, 90% of the face value would be, I think, 1 minute. They have not told the number of units, right? So it will be 4 lakh 50,000. So 10% debenture, 5 lakh into 90% is equal to how much? 4 lakh 50,000. Everybody clear with this part? Next. Down they have told other investments are at par. So this is at par. This is also coming at par. Now down they are saying, given that the operating expenses during the year is 5 lakh, also find out. So expense payable is going to be how much? 5 lakhs. Expense payable 5 lakh. If the mutual fund has distributed a dividend of 0.8 rupees, so dividend distributed 0.8 rupees per unit, they want you to work out the NAV. So first you take 1 minute, write down this basic data, understand till here, then we will go and work out the NAV. All right, friends, are you all done writing till here? Now tell me, how do you work out the NAV? What's the formula for NAV? All the assets at realizable price minus all the liability at realizable price, whole divided by number of units, correct? So you have a cash of 2 lakh, you got dividend of 12 lakh, you will get interest on all the debentures, minus you will pay 5 lakhs, so your cash balance becomes 10 lakh 51, plus government security at par, equity share at 87.5 we found out. This will come down to 4 lakh 50 assets and NAV. Can you write down this on your own now, friends? Please write down this in your books and find out the NAV on your own. All right. Did you get the answer? 11.55. From 11.55, if point is a unit way, you get the balance amount as 10.5. So, friends, we are done with this question also. Can I go to the next question now, friends? Wait, wait. Yeah. Friends, am I audible now? Sorry, sorry, sorry. Sorry, friends. Am I audible now? I went to get some water. I forgot my mic over there. So sorry, friends. Okay. I am back now. I hope everybody is clear. So I just said one thing, that your dividend is 0.8, correct? 11.55 minus 0.8, your new NAV will be 10.75. The moment you pay dividend, there's an outflow, your NAV comes down. Okay. So sorry, everyone. So I think we are done with this part. Okay. Can I go to the next question now? All right. Let me go to the next question. Now we will go to the chapter of options. Ready? Question number 1. We'll do the first question, page number 7.56. Friends, I hope you are all enjoying the mastery book. I've given it a very, very discounted price, heavily discounted price for the effort that I've taken. I've spent 4 to 5 years on this book, friends. Next time, I will not give this kind of offer, okay? So, you will be one of the lucky bunch who would have got this book for that low price, but please do value it. The efforts involved is very, very huge. Whoever has bought the book, please, please read it, please study through that, okay? 7.56. Let us do this question. Question number 1 is what we told, right? Okay. So options chapter, additional practice, question number 1. Working note number 1, basic data. A purchased 3 months call option for 100 shares. So I'll just put it like this. Particulars, 3 months call option. Number of shares, how many shares? 100 shares at a premium of 30 rupees per share. So premium is how much? 30 rupees per share. Exercise price of 550. EP is going to be how much? 550. He also purchased the 3 months put option. So he has done buy call. Same way, what has he done? Buy a put option. Okay. Call option is a right to buy. Put option is a right to sell. Buy a put, how many shares? 100 shares of the same company at a premium of how much? 5 rupees per share. Exercise price of 450. Okay. Now they are asking the market price as on the date of Mr. A's purchase option is 500. Calculate the profit or loss he will make if the market price falls down to 350. So what I'll do is I'll just put profit or loss if price falls to 350. All right. So now I'll put over here actual price 350. So based on this, we have to take the action now. So everyone interact with me. I have a right to buy at 550. Outside market, I can buy for 350. Will I exercise or will I lapse in that case? In that case, I will lapse because I have a right to buy at 550, but outside I can buy for a very lower price. So once I lapse, my GP becomes 0. My net profit will become that minus 30. That will be minus 30. Now, I have a right to sell at 450, outside market 350. What will I do now? I will exercise. I'll get 100 and minus 5, my net profit will be 95. Both together, my final adjusted profit will be how much, friends? That will turn out to be how much? It will turn out to be 65. Correct? So this is for one share. So for 100 shares, what will be my answer, friends? 65 into 100 shares. I'll get my overall profit as how much? 6,500. Everybody clear with this part? Shall we go and check? Yes, they have got the same answer. Can you write down and finish it off, friends? We are done with this question also. All right, friends. Can I go to the next question now? Are you all done writing till here in your books now? All right, let me go to the next one. What is the next question that we have here? Options, we are having question number 3, page number 20. Wait, no, not page number 20, page number 57. All right. Let's do question number 3, options additional question. Working note number 1, basic data. Equity share of PQR Limited is presently quoted at 320. 320. The market price of the share after 6 months has the following probability distribution. Market price 180, 260, 280, 320, 400. They have given you the price and they have given you the probability over here. All right. A put option with a strike price of 300. All right. Now they are asking you to find out the expected value of the option. So friends, how we will do this is I'll write down here itself. Working note 2, expected value of the option. Okay. So here what we are going to do is we'll put the price first. So the table format over here will be S1, E1. We'll put it this way. Okay. Then we will have action. So for example, in the first case, you have 180, but you have a right to sell at 300. What will you do? Exercise. By exercising, you will sell at what price? Now you're going to sell it at 180. Am I right? So sell value will be 180. This has a probability of how much over here, friends? 0.1. Now they're asking you to find out the value of the option on maturity. So I think in that case, once your action is exercised, we'll put the GP over here and then we'll put the probability. GP probability. So my GP will be, in that case, because I'm exercising, I have a right to sell at 300. Outside market 180, my GP will be 120. What is my probability? 0.1. So what will be my GP into probability? 12. Next is 260. 300 exercise. 40 with a probability of 0.2, that is 8. Next one is 280, 300 exercise 20. It has got a probability of 0.5. So I'll get the number as 10. Next one would be 320. Here it is 300. Lapse GP will become 0. 0.10. Last one is 400. 300. Lapse 0. 0.10. So when I add up all this, you get 12, 8 is 20, 20 plus 10 is how much? It turns out to be 30. Everybody clear with this part now? 30. Okay, correct. Let's just go down and check. Yes, they have got exactly the same answer. Can you write down this in your books, friends? With this, we are done with this question also. All right, friends. Are you all done writing till here in your books now? Perfect. Can I go to the next part? All right. We are done with question number 3. Now, shall we do question number 6, page number 7.61? All right. We have the next question. Question number 6, page number 7.61, options, additional practice question. This question has come in study material, May 2018 exam, RTP November 2024 also. So a very, very good question. Question number 6, working note number 1, basic data. All right. Now, So friends, here, 1 minute. When I put basic data, equity share of VCC is quoted at 210. Okay, so the MPS today is how much? 210. A 3 months call option is available at a premium of 6 rupee per share. Premium 6 rupee. 3 months put option is available at a premium of 5 rupee per share. This is 6 rupees for what? Call option. 5 rupees what? 3 months put option. Okay. Next. Ascertain the net payoff to the option holder of the call option and a put option separately. Strike price in both the cases is how much? 220. So the exercise price is 220. And down they have given certain prices. All right. So let me just do this first one and I'll show you. Payoff table for a call buyer. So the table format will be S1, E1, action, GP, premium, net profit. So for example, the exercise price is how much? 220. Actual price is 200, 210, 220. Then you have 230. Last one you have 240. So call option, I think it's buy a call, right? 3 months call option is available and 3 months put option is available. I have a right to buy at 220, outside market 200, lapse, exercise or lapse. Exercise you get 10, exercise you get 20. What is the premium for call? 6, 6, 6, 6, 6. So minus 6, minus 6, minus 6, plus 4 and 14. Like this, you have to do the put option. Can you do the put option part separately, friends? Yes, Abby. Value of an option means GP. Thanks for correcting that. All right, friends. Are you all done writing till here in your books now? Like this, can you do for put option on your own? I think, did I get minus 6, 4 and 14? Correct. Like this, put option also you're supposed to do. All right. Try doing it yourself. Fantastic. So friends, here what happens? You have a right to sell at 220, outside market 200, exercise, GP, premium, net profit. So you get 15, 5, minus 5, minus 5, minus 5. Okay. Perfect. So friends, we are done with this question also. Shall I go to the next question now? So we have done with question number 7. Now let us go for 7 is done, is it? No, I think 7 is pending. 7 is a very, very good question. Shall we do it together now? Question number 7. option valuation, additional questions. Okay. Working note number 1, basic data. Sumana wants to buy the shares of EIL, which has a range of 411 to 592. The present price is 421. Okay, let me explain to you. What is the current price of the price of this particular share? S0 is equal to 421. The price can either go up to 592 or it can fall down to how much? 411. Okay. Present price is 421. Her broker informs her that the price of this share can go up to 522 within a month or so that she should buy the 1 month call of EIL. In order to be prudent, the share price should be at least more than 522, the assurance of which could not be given by the broker. So broker had no idea whether it will go above 522. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price of 592 so that the buying of 1 month call is justifiable. So friends, how do you do this? In order to get the probability, there are two methods. One, you can use binomial model or you can use risk neutral model. Okay, P1 minus P. So I'll just show you this answer using both the models so that you understand the concept. So I'll just write down over here method number 1, solution using risk neutral model. Solution using risk neutral model. All right. So here, what we do over here is that what is the current price of the share? Is it turning out to be 421? 421. So from this 421 that has gone to this particular person, minimum return expected is 3.6%. All right. So it will be 421 into 3.6% is turning out to be 15.19156. This is the minimum return expected. Profit if price goes up. So everyone tell me what will be the profit if the price goes up? 592 minus 471 will be 171. Loss if price falls down. So the price falls down, 411 minus this, you make a loss of 10. So they are saying 171 into some probability plus minus 10 into 1 minus probability on an average should give at least 15.156. Or in other words, 171p minus 10 plus 10p is equal to 15.156. Or in other words, 181p is equal to 25.156. So p is equal to 25.156 divided by 181. I'll get the answer as 13.89 percentage, or approximately this will be how much percentage, friends? 14 percentage probability. Can I cross check if I have done it correctly? Yes, they have got the same answer over here, friends. Can you write down this in your books now? All right, friend. Did you get the answer as 14%? Now, once you're done with this method, I can show you the answer using the second method. Method 2 is binomial model. All right, can we do it in this method now? Under this method is very simple. I minus D divided by U minus D. So I is the interest 1.036 minus D will be the proportion of downside to the spot price 411 divided by 421. Whole divided by U minus D. U is 592 divided by 421 minus 411 divided by 421. So in other words, you get 0.0597 divided by 0.4299. 0.1388. Everybody clear with this part now, friends? All right. Yeah. Okay, they have taken the continuous compounding. So they've taken 1.037. I have taken 1.036. That's a small difference. If you take 7, you'll get a slightly different rounded off figure. Everybody clear with this part now, friends? Perfect. So we are done with this question also. Yes. So friends, options, we have done this question also. Now, shall we go to the next area of futures? 23rd question, question number 10, page number 7.104. Okay, this is the question. Friends, this question has a small mistake in the textbook. That's the reason I'm doing this question over here. Question number 10, additional practice questions, futures. Shall we do it now? Okay. Working note number 1, basic data. So calculate the price of 3 months PQR futures if, okay, so let me say they want to find out the price of 3 months PQR futures. All right. If the face value is 10 rupee, price P0 is equal to how much, friends? Is it turning out to be 220 rupees? On NSE, and 3 months future price quotes at 230. 230 rupees. And the 1 month borrowing rate is given at 15%. Borrowing rate is 15%. Expected annual dividend is how much? 25%. I'll first show you the correct way of solving this question. Okay. Shall we begin with that part, friends? All right. So here what they're asking is calculate the price of 3 months future and also examine the arbitrage opportunities. So friends, first what we need to do is we need to go and find out the theoretical future price. How do you find out the theoretical future price? F0 is equal to S0 into e raised to RT. Okay. So your future price of 200 and, sorry, theoretical future price is what we are trying to find out. So F0 is equal to S0, that is 220, correct, into e raised to, this is 0.15 R minus Y. Here you have a dividend yield, so the equation will be slightly different. It will not be e raised to RT, it will be e raised to R minus Y into T. This whole multiplied by 3 months, right? So 3 divided by 12. Or F0 is equal to 220 into e raised to minus 0.025. So that is 220 into 1 divided by 1.025 and 0.025 square divided by 2. 1.037. Hold on. 1.025. 1.0253125 divided by 1.0253125. You get the answer as 214.56. Once you get the theoretical future price as 214.56, we can check about arbitrage opportunities. Arbitrage opportunities. So here what we will do is we'll first take the theoretical price. So everyone tell me what is the exact theoretical price that you get over here. Do you get the answer as 214.56? Point number B, what is the actual price that you get over here? Actual price is 230. So from this, can I say the actual price is overvalued? So in that case, what are you supposed to do? You are supposed to sell futures. This is the real answer, friends. First, you write down this. Then I will show you how your textbooks have done it. Friends, are you all done writing till here in your books now? All right. So once you're done writing till here in your books, let me go to the next part. This is actually how we are supposed to do it. But in your textbook, what they have done is they have done it like this. They have found out the future price using the formula 220 plus 220 into 15% into 0.25 minus 0.25 into 10 to 25.75. Basically, what they have done is this 25% dividend that is given over here. Ideally, it is supposed to be dividend yield. That's what they provide. They are told annual dividend is 25%. Here, they are assuming it to be dividend rate. So once it is dividend rate, the whole equation changes. Not only that, they have used simple compounding instead of using it as continuous compounding. So I'll just write down over here. Textbook has assumed it to be dividend rate and they did not use continuous compounding. This is the difference, friends. Okay. I hope you're clear with that part. So that way they got a very different answer. They got the price as 225, but actual price is 230. It is overvalued, sell. So the answer what we got is sell. They also got the same answer as sell itself, but the way we did it, was a little bit more logical way of doing it. Okay. And the proof also what they gave in the textbook is very, very confusing. We don't need to do all that because once it's overvalued, its sell means what? You are going to sell at 230. Tomorrow, you will buy it back at what price? 214. Okay. You are going to make a profit of how much over here? I'll tell you. Proof. Proof actually goes like this. Today, you are selling at what price? 230. On expiry date, today's spot price is going to be 220 along with all the interest or etc. You will turn out to be how much? 214.56. So now tell me what is going to be your profit over here? Do you make a profit of 15.44? That's it. This is your proof. Everybody clear with this part now? They would have also got, they have done using simple compounding, so the numbers are slightly different compared to whatever we have got. Otherwise, we both will get the same answer. Okay. So can you write down this and finish it off, friends? With this, we are done with this one question on futures also. All right, friends. This is what I wrote in the reading part, Sarvamangala. Textbook has assumed it to be dividend rate instead of dividend yield, and they have not used continuous compounding. Okay. So we are done with this question, friends. Shall I go to the next question now? So we are done with this. Let us do the next one. Question number 14, 7.108. This is a very good question, friends. Shall we do it? Question number 14, Futures chapter, page number 7.108. Basic data. Ram buys 10,000 shares of X Limited at a price of 22. So I'll draw particulars X. Number of shares 10,000. Point number B, price. What is the price that you're getting over here? 22. All right. So from this, what will be the market value that you get over here? Do you get the market value as 2,20,000? Whose beta value is 1.5. Beta 1.5. And sells 5,000 shares of A Limited. So the second one is A Limited, 5,000. Here, what is he doing? He's selling. This one, what is he doing? He's buying 5,000 shares at a price of 40. So do I get the value as 2 lakhs over here? Correct? All right. Having a beta value of 2. Then they are saying he obtains a perfect hedge by doing Nifty futures at 1,000 each. Friends, how do you do a perfect hedging? S0 into beta into 100 percentage, correct? So what I will do, what is S0 into beta? Let us find that out over here. So this one is buy, this one is sell. So 2,20,000 into 1.5 would turn out to be 3,30,000. And 2 lakh into 2 would be how much? 4 lakh sell. So what is the common mix up of all these things together? Do you get the answer as 70,000 sell? Correct. Now this is done at Nifty. So what will be the number of contracts? I think they have told Nifty futures of 1,000 rupees each. So I think you will get how many contracts over here? 70 contracts. So S0 into beta into 100 percentage. This is the answer. Can you write down till here in your books now? Abby, go by continuous compounding because that's what they're teaching you everywhere else, right? All right, friends. Are you all done writing till here in your books now? Now let us read. What they are saying is that he closes out his position at the closing price of the next day when the share of X. Okay, so he's closing out on the next day. So I'll write down the next working note, closing out. Particulars X, A, Nifty. First, I will write down the current position. So everyone tell me what was the current position of X? It was buy at 2,20,000. And what about in case of A? Sell at 2 lakh. Sell, correct? What about the Nifty? Sell at 70,000. Now he's closing out after a percentage change that is happening over there. So what's the change they have told? Share of X drops by 2%. So this is a fall by 2%. A goes up by 3%. This goes up by 3%. And Nifty drops by 1.5%. So can I find out the closing value based on this? 2,15,600, 2,06,000, 68,950. So based on this, I can find out the gain or loss, correct? Gain, or I'll put the loss in minus. So 2,20,000 minus 2,15,600 is a loss. You make a loss of 4,400. Here you sold it, so you are again making a loss of 6,000. Here you have sold it, so you make a profit. 70,000 minus 68,950, you make a profit of 1,050. All together, you make a loss of 4,400 plus 6,000 minus 1,050, 9,350. So your loss will be 9,350. Let me just confirm that. No, 11,450. I've made some small mistake. Nifty, hold on. I think I've made a small mistake over here. Hello, am I audible now? Am I audible now or is it very loud? 1 minute. Am I audible now? Is it clear now? Is the sound comfortable for all of you? Okay, what about now? Is it very loud? Should I reduce it even further? Now audible and clear, right? Sorry, friends. I think suddenly the mic battery got over. I didn't realize that. I'll just repeat once again, friends, what I was trying to say. For Nifty, it is going to be buy. All right, 70,000 you're going to buy. Why? Because net position of these two is 70,000 sell. So Nifty, I take the opposite position, correct? So that will be 70,000 buy. Perfect, perfect. Thank you so much. 70,000 buy. So you get buy 70 contracts. So here you will see 70,000 buy and your net effect will be a loss of 11,450. Can you write down this and finish it off, friends? With this, we are done with this question also. Friends, with this, we are done with this question. All right, friends. So shall I go to the next question now? Perfect. So we are done with 24. Let us do the next question, which is a beautiful question on Forex. Question number 10, page number 8.60. Yes, 8.60, question number 10. So let's do question number 10, Forex, page number 8.60. All right. Yes. Working note number 1, basic data. Working note number 1, basic data. An Indian importer has to settle an import bill for 1,30,000. So import bill means what, payable or receivable? It will be a payable. What is the value of payable? Everyone tell me. $1,30,000. The exporter has given the importer two options: pay immediately, no interest charge. Next one, he's saying pay after 3 months but 5% interest. All right. Now they have told importers bank is charging 15% on OD. Charges 15% on OD. Spot rate is given and the 3 months forward rate is given. 48.35 hyphen 48.36. Forward rate is given as 48.81 hyphen 48.83. All right. Can you quickly write down till here in your books, friends? All right, friends, are you all done writing till here in your books? Okay. Now, I'll go to the next parts. I'll just show you. We will first do option number one. So, what happens in option number one, friends? You are going to pay immediately. Correct? So, when you pay immediately, what is the dollar payable by you? Is it turning out to be $1,30,000? Correct? Now, point number B, if you want to pay immediately, today only you have to make the payment. So, today will you take the spot bid rate or the spot ask rate? You will have to go to the bank and buy dollar. Bank is selling dollar. Dollar is the commodity. Ask rate 48.36. All right. So now tell me when you do like this, how much will be the rupee payable over here? Do you get the answer as 62,86,800 rupees? Correct. So now what happens is on this you will have to pay interest at the rate of 15% for 3 months. That will be 2,35,755. Once you're done with this, I will get the closing balance. So this plus 62,86,800 will be 65 lakh 22,555 rupees. Perfect. This is if I pay immediately. Now I will show you option number 2 also. What is option number 2? Pay after 3 months. So here what will happen? Your dollar payable is equal to $1,30,000. We will add interest. I think in the second case, what is the interest they have told? 5% for 3 months. Is that turning out to be $1,625? Correct. So point number C, what will be your closing balance? 1,31,625. Now you will use 3 months forward ask rate. What is the 3 months forward ask rate? 48.83. Do I get the answer as 64,27,000? 64,27,249. So which is cheaper, friends? This one is better. Can I just cross check with the solution? 65,22,555. 64,27,248. Perfect, friends. Can you write down and finish it off? We are done with this question also. All right, friends. So we are done with this question also. Shall I go to the next question now? Forex, question number 12, 8.63. All right. This is a very good question and it came in the exam also, friends. Then it came in RTP after that. So let's just do this question now. Okay. Question number 12, Forex. So here they have given three rates. USD bar INR is 43 rupees. JVP bar INR is 77.52. GBP bar USD is 1.6231. Arbitrager has 100 lakh dollar with him. There are no transaction costs. Explain whether there is any arbitrage gain. I'll show you what we can do. See, you start with 100 lakh dollar. First, this you convert into rupee. What is the rate? 48.3. So when you do it at this rate, you will get 100 lakh into 48.3 is 4830 lakh rupees. Then once you get 4830 lakh rupees, next rate is 77.52 rupee per pound. 77.52 rupee per pound. This one is 48.3 rupee per dollar, correct? So 4830 lakh rupee divided by 77.52 will give you 62.30 lakh pound. From here, when you have the next one as 1.6231 dollar bar pound. 1.6231 dollar bar pound. So this into 1.6231 when you do, you get the answer as 101.129 lakh dollar. So if you just check over here, 100 lakh without you doing anything has become 101.129 lakh. What is the profit you make over here? 1.129 lakh dollar. Can you put this chart in your books, friends? With this, we are done with question number 12 also. All right, friends. So we are done with question number 12 also. Shall I go to the next question? Question number 13. Another good question on IRPT. Question number 13, Forex, page number 8.64. Working note number 1, basic data. The US dollar is selling in India at 55.50. So, okay, wait. Sarmangala, very good question. How do we present in the exam? Okay, sorry, I gave you a chart. You can just write down one by one. Point number A, convert 100 lakh dollar into rupee. Step 2, convert rupee into pound. Step 3, convert pound into dollar. Step 4, arbitrage profit. Like that, you can write down Sarvamangala. Alright? Yes. So, what is the spot rate coming over here? Is it 55.5? Interest rate for 6 months borrowing in India is 10% per annum. So, 6 months interest rate. If 10% per annum means 5% for 6 months. Correct? And the corresponding rate, this is the rate in India. Rate in USA is how much? 4%. That is 2% US. They are asking, do you expect the dollar to be at a premium or at a discount? Shall we do that on your own? Working note number 2, theoretical future price. Now everyone tell me, how do you find out the theoretical future price? 1 plus RH divided by 1 plus RF is equal to forward divided by spot. Am I right? So that will be 1 plus 5%. This will be equal to F divided by 55.5. Do I get the answer as 57.13 rupees per dollar? Correct. Once I get this, can I say forward rate will be at a premium? Forward rate will be at a premium. Everybody clear with the first part? What will be the expected forward rate? What will be the rate of forward premium? So we need to find out the forward premium or the rate of appreciation. How do we normally find out the rate of appreciation, friends? It will be positive. So 57.13 minus 55.5 divided by 55.50. Do you get the answer as 2.93% will be the rate of appreciation? Shall we check the answer? 57.13, 2.94%. Perfect. So we are done with this question also. Can you please write down this in your books now? All right, friends. So we are done with this question. Perfect. Shall we go to the next question now? 28th question, 20th of the Forex, page number 8.72. All right, this is another question on IRPT, arbitrage opportunity. Shall we do it now? Question number 20, Forex, page number 8.72. Working note number 1, basic data. Spot rate, that is equal to 48.0123 rupee per dollar. Point number B, 180 days forward rate. One 80 days forward rate 48.8190. 48.8190. Annualized interest rate for 6 months is 12 percentage. So 12 is for 1 year. So for 6 months, it will be RH will be 6%. RF is going to be how much percentage? 8 for 1 year. So it will be only 4% for 6 months. Is there any arbitrage opportunity? Friends, in order to determine whether there is arbitrage opportunity, we normally go by 4 steps. Step number 1, we try to find out what is the theoretical RH. So for theoretical RH, the formula is going to be 1 plus RH, sorry, 1 plus RH divided by 1 plus 4% is equal to forward divided by spot. Do you get the answer as 5.74 percentage? This is the theoretical RH. Now we will take the actual RH. Everyone tell me what is the actual RH that is given over here? 6%. So can I say actual is more expensive than required? In that case, what are we supposed to do? We are supposed to invest in RH and borrow in RF. Can you write down till here in your books first? All right, friends. Are you all done writing till here in your books? Now I'll give you the proof. Okay. So now when you go to the proof part, what we will do is I'll put India and here I will write down US. Okay. So how we are going to do it is, I think we took a decision that we are going to invest in RH and borrow in RF. So I am going to come over here and I will borrow how much? I think in the question they have told borrow $83,312. I will borrow this at how much percentage? 4 percentage. So what is 83,312 plus 4 percentage? 86,644. Okay. This amount which is borrowed will be converted at the spot rate of 48.0123. That is equal to how much rupees? So I will invest over here 40 lakh rupees, which will be invested at RH of 6 percentage. That is 42 lakh 40,000 rupees. Got it? At the end of the period, what I have to do is I will have to withdraw this money to repay the loan over there. Correct? So what is the S1 or the spot rate afterwards that we found out? 48.8190. So when I convert, I will get $86,851.44. This will be repaid. This will be received. So I get still a profit of $207. Hence proven that we can make arbitrage profit. Can I cross check? Yes, same answer. So this you can write down like this in stepwise manner, but I have given you in a chart-wise manner to understand this thing better. Can you write down this and finish it off? We are done with this question also. All right, friends. Are you all done writing till here in your books now? So we are done with this question also. And friends, these were the questions I had scheduled for Forex. Now shall we go to the next chapter of mergers, friends? Question number 17 of mergers. We are left with two more questions, friends. So I think we'll do this in one shot and then I will conclude the session rather than giving a break in between. Is that okay? Right? All right. So what is the question on mergers? 11.58, question number 17. Okay, this is the question. Yes, friends, this one question actually is in such a way that majority of the questions are like this only. That's the reason I'm doing this. Okay. So question number 16, mergers and acquisitions, page number 11.58. Working note number 1, basic data. XYZ is considering merger with ABC. XYZ shares are currently traded at 20. So 1 minute, I'll put a table, particulars. XYZ ABC. Point number A, MPS. So XYZ prices are currently traded at 20. Point number B, it has 2,50,000 shares outstanding. 2,50,000 shares outstanding and its earnings after tax is 5 lakhs. 5 lakhs. ABC has 1,25,000 shares outstanding. Its current market price is 10 and earnings after tax is 1,25,000. From this, can I find out the EPS? That will be 2 rupee and here it will be 1 rupee. From this, can I go and find out the P ratio? P ratio will be 10 times 20 divided by 2 and here also it will be 10 times. Total earnings after tax will be 6,25,000. Alright. So I think we have got the basic data clear. There is a swap ratio. Current market value of ABC shares. So the exchange ratio that is based on the MPS. So everyone tell me what will be the exchange ratio based on the MPS. It will be 1:2 for every one share that is based on this one. For every two shares of ABC, XYZ will offer only one share. For every XYZ will offer only one share. Can you write down till here in your books first, friends? All right, friends. Are you all done writing till here? Now they're asking what is the pre-merger earnings per share and PE ratio of both the companies. Have you already got the answer for that one? If ABC has a PE ratio of 6.4, what will be the market price and the post-merger EPS? All right. Now we'll write down working note number 2, analysis. In this, I will write down Roman number 1, post-merger EPS. So So how do you find out the post-merger EPS? Total earnings after merger divided by number of shares after merger. So number of shares will be 2,50,000 plus 1,25,000 into 1 divided by 2. So 6,25,000 divided by 3,12,500. You get the answer as how much? 2 rupees per share. Once I get this, Roman number 2 will be what? Post-merger MPS. Post-merger MPS is nothing but post-merger EPS into the P ratio of the acquiring company. So what is the P ratio of acquiring company? 6.4, is it? ABC. Considering merger with ABC, XYZ shares are traded 2,50,000 share. ABC's, it's actually, friends, P ratio of the acquiring company. That is supposed to be XYZ. Maybe it is a typing mistake. Okay, they're asking if ABC's P ratio is 6.4, then the MPS of ABC will be 6.4. But right now we already have the MPS of ABC. What is the MPS of ABC? It's already given as 10. Maybe they're asking if it is 6.4, what will be your answer? Then your exchange ratio will also change. Okay, 1 minute. Okay, we'll do that separately. I think 2 rupee per share is okay. That is correct. Combined earnings 5 lakh. Then the number of shares will change. Okay. So we'll put it this way first, friends. We'll just write down post merger EPS is 2 rupee per share if exchange ratio is 1:2. I think we'll stick to this and then we will do the next part in the next page. Can you all please write down till here in your books now? Friends, I hope the class is absolutely comfortable for everyone. If you're facing any difficulty, let me know. Okay. And yes, I forgot to tell about the timestamps. If anybody has noted down, please do put it in the comment box. Okay. And please like to this video and subscribe to this channel if you find these classes useful. Many more classes are coming one by one. It's all done for your benefit, friends, to take the best out of this. Thank you so much, Rahul. Thank you. Thank you so much, Rahul. All right. So are you all done with this? Now we will write down the next working note. MPS if PE ratio of ABC is 6.4. So here I'll write down MPS will be equal to 1 rupee per share into 6.4 times, or that will be equal to 6.4 rupees. Therefore, exchange ratio will be 6.4 is to 10. Am I right? Sorry, 6.4 is to 20. 6.4 is to 20. In this case, my post-merger EPS will change. Now what will be my post-merger EPS? Now it will be 6,25,000 divided by 2,50,000 share in the first company plus 1,25,000 into 6.4 divided by 20. 2.155 rupees per share. Can you write down this and finish it off? Thank you so much, Rahul. Thanks a lot. Thank you so much. Thank you so much, Rahul. Just now I checked the timestamp. Thanks a lot. So I believe you're all done writing till here in your books now. Can I go to the next one? Okay. So I think we got 2.155 as the answer. Yes. And then what is the last part of the question? What should be the exchange ratio if XYZ's pre-merger and post-merger EPS are to be the same? Friends, if pre-merger and post-merger EPS are to be the same, the exchange ratio should be based on the EPS. So it will be 1:2. Let's check. Yes, 1:2. It should be based on EPS. Everybody clear with this part? So friends, with this, we are done with this question also on mergers and acquisitions. Now friends, I think we are left with only one more question in the Super 30 edition. Shall we go and do this now friends? Question number 5. Beautiful question. Question number 5, corporate valuation, page number 10.14. Working note number 1, basic data. Basic data. ABC company is considering a new sales strategy that will be valid for the next 4 years. They want to know the value of the new strategy. So friends, basically, they have two things over here. Existing strategy, then they are having a new strategy. All right. So what's happening is they want to find out the new strategy's valuation. Okay. So this will be valid for how many years? It will be valid for 4 years. Everybody clear with this part? Okay. Hi, Anand. Yeah, I have also this full Super 30 are very good questions plus 25-hour marathon link I shared in the previous class. You have to just visit my YouTube channel. You want me to put it over here? The exact link? One moment, I'll just arrange that for you right away now. This is my channel, friends. So when you enter into my channel, go to the playlist. In the playlist, you will have revise AFM in 25 hours. So let me just take this, and this is applicable for January 26. I've copied the link and I'm posting it here now, okay, in the chat box. So friends, that's my channel where you'll get many more important things. You can just subscribe to that channel also immediately, friends. So it will be very, very useful for you. Okay, right. So now let me continue doing this question. So you have an existing strategy and then you are also having a new strategy coming in, correct? Okay. So what I'll do is I'll take this. Down they have given you sales, GP, admin, PBT, tax, PAT, asset, current assets, equity. If it adopts a new strategy, sales will grow at 20%. So I'll write down the next working note heading, projected P&L account. Here, 0 is given, 1, 2, 3, 4. So what is the sales which is given in the base year data? Is it given as 20,000? It will increase at the rate of 20% per year for 3 years. So 24,000, 28,800, 34,560, 20% for 3 years. From 4th year onwards, cash flow will be stabilized. It will be exactly the same. All right. The gross margin ratio, asset turnover ratio, capital structure, and income tax remains the same. So what happens is their profit after tax is 1,400. Okay. So 1,400 divided by 20,000 will give you 7%. So based on this, their profit after tax of 7% will remain the same. So here I'll get 1400. Here I'll get 1680, 2016, 2419.2, 2419.2. This is going to be my PAT. Everybody clear? So after I get my profit after tax, in order to find out the cash flow, what will I do? Add depreciation minus capex minus additional working capital will give you the free cash flow. Am I right? So in order to get this, what I will do is, okay, first we need to find out depreciation, capex and working capital. We'll do it one by one. So I'll write down the next working note heading, analysis of fixed assets and depreciation. All right. So here I'll draw another table. Here 1, 2, 3, 4. Opening balance. What is the opening balance that you have over here? Is it turning out to be 8,000? Then we will have addition less depreciation will give you your closing balance. Everybody clear with this part? So my opening balance is how much? 8,000. Addition, I don't know yet. They have told depreciation would be 10% of the net assets at the beginning. So here the depreciation would be 800 for year 0. I don't know what they have. Okay, what next I will tell you. We also know that the asset turnover ratio will remain the same. So 8,000 is the asset, sales is 20,000. So can I say 20,000 divided by 8,000 means it is going to be 2.5 times. 2.5 times is the asset turnover ratio. Or in other words, when the sales is 24,000 divided by 2.5, your asset value, okay, hold on, I think I made a small mistake. 8,000 is the closing value of this year, year 0. So 8,000 will be the opening value over here. The closing value over here will be 9,600. Depreciation will be 10% of the opening value. So from this, I can do a reverse working to find out the addition. We'll do that later. Year 2, we have a turnover of 28,800. Divided by 2.5 will give you 11,520. Third year, the sales is 34,560. Divide by 2.5 will give you 13,824. Fourth year opening and closing will remain the same. All right. So now the balancing figure will be your addition. So 8,000 plus something minus minus. Do you get the answer as 2,400 over here as the addition? This will be 960, 1152, 1382.4. 11,520 plus 960 minus 9,600. 2,880. 3,456. 1382.4. So basically what is happening in the last year is that your capex and depreciation gets offset. Okay, this is one part. Can you write down this? So all this is what we call it as capex. This is what we will call it as depreciation. Can you all write down till here in your books now? All right, friends. Once you get this part, then I will go to the next working note. Analysis of working capital. Year 0, 1, 2, 3, 4. All right. So now here I'll write down working capital is nothing but the current assets. Correct. So let's go and check that first. 4,000 and 20,000. So can I say its turnover ratio is turning out to be 5 times? Am I right? So whatever is your sales, if your sales is 20,000, 24,000, 28,800, 34,560. Again, it is 34,560. This is the sale value. From this, my current asset is going to be 4,000 here, 4,800 over here, 5,760 over here, 6,912, 6,912. So I can find out my additional working capital. Here it will be 8,800. Here it will be 960. Here it will be 1152 and here it will be 0. This is going to be my additional working capital. Can you write down this also in your books now? All right, friends, are you all clear? Then we just have to go and paste these numbers. So for example, depreciation 800, 960, 1152, 800, 960, 1152, and then it is 1382.4. Balakrishnan, I have put all in the first video. You will need to check that to understand where the book and everything is available. Capex is going to be 2,400, 2,880. Then you have 3,456. The last one will also be, I think, 1,382. Correct? Then we'll talk about the working capital 800, 960, 1152. Last year, last year it's 0. Now let's check what is going to be my net effect. 1680 plus 800 minus 2400 minus 800. So you get the answer as minus 720. 2016 plus 960 minus 2280 minus 960 minus 864. Friends, don't write down. Okay, I need to confirm these numbers. 2419.2 plus 1152 minus 3456 minus 1152 minus 1036.8. Last year it will be plus 2419.2. Let me confirm these numbers, friends. 1036, correct. Absolutely correct, friends. Can you write down this? So we got the free cash flow. Now we only need to find out the NPV or the value of this project. All right, friends. Are you all done writing till here in your books? Now, value of an asset is nothing but present value of future cash flow. So here you have high growth cash flow, then you are having perpetual cash flow. So how do you find out the present value of perpetual cash flow? Cash flow in the year of 4 divided by KE minus G. Everybody clear with this part? So I'll just show you that part as a part of solution. Minus 720, 864 minus 1036. Then you have fourth year cash flow divided by 15 points growth. You get 16,126. This number is what you will write down over here. And you get the value, present value as how much? 8641.76. So can you please write down working note number 7 on your own now, friends? All right. Are you all done writing till here in your books? So, friends, we were comparing the new strategy versus the existing strategy. Correct. New strategy, we got the value as how much? 8641. Existing strategy would mean nothing. It would mean whatever profit you're getting now, you'll continue getting. How much is that? 1400. So that will be 1400 divided by 15% minus growth of 0 percentage. So what is 1400 divided by 15 percentage? Do I get the value as 9333.33? So now tell me, friends, which is better, existing or new? Existing strategy is better, so you don't need to go for the new strategy. Write down this, friends. With this, we are done with this question on business valuation also. And with this, we have successfully completed our intensive 2-day Super 30 batch, friends. Thank you so much, my dear friends, for all the support that you have given me. Thanks a lot. I would just like to take 5 more minutes to share with you some content which is very, very important for you, free content also, and I will share some premium content also, which only if you want, you can go ahead with that. Book, which was 750, I offered it to you at a very, very low price, just 100, but that's the last time. I will not be doing this again. Whoever got this, you're all extremely lucky. Please stick to that, and my request is please read and study that book. I have taken a lot of effort to build that book. The whole question is done using my method, basic data analysis conclusion. Every concept is detailed. You can read through the concept. Every concept has a QR code. When you don't understand reading, you can play the video. No other book has this much kind of an elaboration, friends. So my only request is please respect the book and please use it. I'm just going to take 2 more minutes of yours to share with you all the free content which will help you to score marks, and also some premium content which I'll put it in the group also. For the next 1 day, since you all have attended it live, I'm going to give you some crazy discounts on this. Only if you want, you can go ahead, otherwise it's fine. Okay. Free content. I have told you about concept videos. You can learn the concepts video free of cost by visiting my website tarunjagdish.com. Just go to Google, write www.tarunjagdish.com. You will get AFM free concept videos. Oh my god, something wrong with the site. I think it will be corrected by tomorrow. You can just visit my website And the moment you get the website, this thing will be sorted out. You'll have a concept called as AFM free concept videos. Just click on that. It is on the main page itself. Point number 2, in my app, I have given you access to AFM success series. Friends, that is nothing but you are going to revise every topic in a very short span of 1 hour. 1 hour you can do the whole revision. That is really, really useful. So I have given you access to it, but please utilize it. When something is free, many people don't utilize it. Third, chapter wise MCQ. Friends, this is all premium thing which I am giving you free of cost. Every chapter you can sit and write exams and you can evaluate where you stand. For that, you have already been added for a chapter wise MCQ batch. Premium, I have already offered the book which was priced at 750 at just 100. Next, friends, my exclusive recorded lectures, okay, for the next 1 day. If any one of you wants to purchase, okay, it's a unique thing for the Super 30 students. Outsiders won't come to know because it's being done only for you. So here the course is having a price, I'm not sure, 8850. You'll be given a flat 40% off on that for the next 1 day. All right. Apart from this, my online live batch is going to start at Logic Kochi, which is online and offline. 12 days you can finish off the entire AFM. If you feel that will be useful for you, you can attend this. Anybody who's taking a booking of this in the coming 1 day's time, they will offer you a flat 15% off. Last one. If some of you want to learn only IFM and derivatives, okay, so IFM and derivatives is actually available separately in my app. I don't know what was the name. I think it is Forex and derivatives. So this lectures is around 40 to 50 hours. Full Forex, full derivatives. Derivative is futures, options and interest rate derivatives is fully covered over here. I think 1 minute. I'll just check the page. I'll share the link in the WhatsApp group, friends. All right. Somehow I think there is some loading issue happening in my website today. Okay. That is priced at 2,500. You will get a flat 50% off, but all these will be for the next 1 day. Tomorrow midnight 12 a.m. this offer will be lapsed. So these are all the maximum things that I can do for all of you, friends. I hope this Super 30 session was useful for all of you. If yes, please pass on this YouTube link with others also so that others can also benefit from this Super 30. I will be there, friends, with you, studying with you, working with you. Anytime, any doubts, WhatsApp me. I will be there to clear your doubts. You just have to WhatsApp me on 8893495263. I will work along with you. Let's study together. Let's win together. Thank you so much, everyone. Take care. Have a nice time ahead. Thank you.